Welcome to Maine Real Estate Today. I'm your host, Steve Lachance with Integrity Mortgage, and I'm here with my coworker, Billy Kimball, also with Integrity Mortgage. Hi, Billy.
Hey, what's going on, bud?
Good. And we've done some cool shows, but today we want to talk about something a little different.
Yeah, this is
something
that's going to be great topic.
Yeah, you got to listen to this, especially. Don't think investors on this always. First-time home buyers might want to listen up too.
Absolutely, especially in the climate we're in. You know, first-time home buyers are looking at, especially in the Portland area, starter homes at $400,000.
Yeah.
Yeah. That's not affordable for everybody anymore.
No, it isn't. And the reality is a lot of first-time home buyers will come to me and saying, look, I can't find anything due to the inventory, or I'm getting beat out on a lot of stuff. But I certainly can't afford a big, expensive multi-unit either.
Yeah. But that's the thing is, like, you know, everybody looks at it like, all right, you got a $400,000 house, and then you go to look at a multi-unit in the same area, and it's double, triple the price.
Right.
So they're like, well, I definitely can't afford that.
Yeah.
But what they don't understand is that we look at projected rents as actual income.
Yeah.
So, you know, we'll pull up, we'll have an appraiser come look at the property, and they'll say, all right, this is what they get for rents in this area, you know, $2,000 for each unit. And we add that into their application as actual income.
Right.
So it's actually easier to qualify for a multi-unit most times than it is for a regular single-family house.
It really is, especially now where rents have been up quite a bit. You're starting to see that,
going through the roof.
If we're able to use 75% of the rental income with no experience going with a government product, so you can buy up to, 4-unit property now,
Yeah.
with as little as 3.5% down.
It's huge.
And, I mean, it's a big deal. I've had buyers that are saying, well, I qualify for $250,000, and again, this is just for random examples here for educational purposes, but you qualified maybe for $250,000, you're finding nothing out there. I've suggested buying a multi-unit, and they get the same reaction every time. Well, I want a house. I don't want to buy a multi-unit. But if you can't, what a great stepping stone. Maybe live there for a year.
Well, the thing is too, and we were just talking about this before the show, is, you know, if you can't buy a single family house, and it's, you know, that's your dream thing that you want to do, and you have to, you know, buy a multi-unit, it's the same thing as you're doing right now. Mm-hmm. You're renting anyways, so wouldn't you rather be the landlord?
Right, and you know what else is great about it is it's also rate resilient too, because I had somebody say, well, oh my gosh, the interest rate's so high, if I'm going to go to $400,000 now, look at the payment on that. Yeah, look at the rent on that. So you got to take into account, and a lot of times what I've seen is the rental income that it's receiving is way under rented.
Yes.
So
absolutely.
there's so my mortgage,
especially in the last couple of years. I mean, rents, some places have doubled in 2 years.
Yeah.
It's crazy.
So it's real easy when you look at the numbers and say, hey, the rents are up right now, and but this property is not really cash flowing just the way I want it to be, or whatever the reasons are, charge more in rent. Yeah, you can do that, right? Not that we want to be out there telling people, be a slumlord, raise the rent as high as you can go. That's not what I'm talking about. I have one myself where my wife and I it's in Auburn, and the taxes just went up. We're like, what are we going to do? The tax is $500 more now.
That's a justifiable increase in rent, though.
We just increased the rent, and I was really worried about it. And my wife's like, can't we just raise the rent? I'm like, oh yeah, duh. So I don't necessarily have to feel the full pinch of that.
Yep, absolutely.
Yeah, so it is a doable thing.
And, you know, the thing is, too, with rents is, like, you know, house prices, they kind of go up and down, you know, depending on what the economy's doing. Rents never go down. I've never seen it. I've never seen it in the 20 years that I've been doing mortgages.
Very rare.
It's very rare. And it's usually something that happens with the city where, like, you know, a big business leaves or something like that, where rents go down.
Right.
But, you know, if you're buying in an area like Portland, you know, Biddeford, Saco, Lewiston, Auburn, you're never going to have any issues.
No.
Especially renting the place out.
Rent control worries me a little bit, as that seems to be expanding out in everywhere right now. But rent control, everybody has a different view on this, but I don't like anything that's going to limit to what I'm going to do with my own property. Yeah. With exceptions, I do believe there are certain areas where you shouldn't have somebody in and out of there, like a hotel, that can be very disruptive in some areas. But for the most part, I don't want to be told what I can do. Can't rent my property? Why not? Yeah. I can't increase the rent to something that's still within the... I'll give you an example of what I'm talking about. If we were to do rent control in Auburn, for example, the rents that I have right now are vastly under rented. Yep. I have great tenants. They're amazing people, very little complaints. And when they do have a complaint, I'm actually upset they didn't tell me sooner about what they had for an issue. So
you should have been at a higher level anyways.
Yes, and I don't want to change that. But here's the thing. If they put rent control and say I can't go up more than 5% a year, and
you're still playing catch up.
Yeah, if I get in financial trouble, I'm going to have to do something major that's just going to disrupt everyone. I can't just, we'll go up 5% this year. It doesn't solve my problem. 5% next year. So it's going to guarantee that I will have to go up 5% every single year just to make sure I don't get myself personally in trouble financially.
Exactly.
A lot of people don't think about the landlord because we're evil, right? It's not always the case.
It's not the little landlords anyway.
No.
It's not the people that have 3 or 4 different buildings. It's the big corporations that own 500 different buildings and they don't answer your emails.
If you have 100, maybe they limit it, something like that. I mean, I would rather see that. No different than a water runoff tax.
Yeah.
Did we get a discount when it was a drought?
Exactly. The thing is, most rental laws, across the nation, they cover renters very well.
Yes.
The landlord definitely doesn't make out with the rules that they have for renters. But there has to be stuff in place that, protects the renters. Our country is filled with renters, so we have to have rules for them. But I agree with you the same ways. If I own a property, I feel like I should be able to do what I want with it.
Exactly.
To a certain extent.
Of course, yeah. I mean, not burn it to the ground or anything like that. But the reality is there are times and places for those things where it is needed. So I get that. But what we want to stay focused on today is that you can still buy a home if you're finding the inventory is poor and you're looking to make a purchase and your lender's not giving you a high enough qualification. It doesn't have to be a quote unquote investment property. Live there for a year. My first one that I purchased, I figured this isn't for me. I hated it. In fact, after I bought it, I hated it because I wanted to be in my own small house with a white picket fence and have the American dream. I did not want to be in, the light bulbs out in the bathroom and all that stuff.
Yep.
But after 12 months of it, I finally realized that when I did my taxes when I woke up.
Yeah, it's huge.
When I did my taxes, I'm like, wait a minute.
Whole different ballgame.
I'm showing income now that I didn't have before. Plus, if I move now, I can rent that unit out that I was in because the house didn't go up in value. It stayed the same.
Yep.
So I can now rent that unit out and get 75% of that rental income added on to what I had in my tax return, which helped me buy the house that I wanted.
Exactly.
It was a huge difference, and I only do it for 12 months.
Yeah. And, the thing is, especially in this economy, 30 years ago, you could have a regular, normal job, work 9 to 5, not make a killing, but you could get by, right?
Yeah.
Everybody that are first-time home buyers right now, I've been pushing, go buy a rental unit, go buy a multi-unit, because this is income that's going to help you throughout the rest of your life. Mm-hmm. It's going to be a retirement plan. You know what I mean? If you do it right and you hold a property your whole life, it's going to double, if not triple in value.
Sure.
Right? And then you're sitting on, you buy a $400,000 house that's now worth, 1.3 when you retire. You have all that equity. You know?
Yeah. And you know what? Here's what happens.
With a very little work,
Well, you just hit on what I was going to say, because here's what happens. A lot of buyers that are in that position say, well, that's great, Steve, but my job demands too much of me. I don't have time to
hire a property manager.
Exactly.
Simple.
You can hire property management companies that will come in. Yeah, you won't make as much money every month, but it's passive income at that point. You don't have to do anything. In fact, they hand you your tax forms at the end of the year and say, take this to your accountant. Yeah. It's all done. They make the payments, take care of everything.
The biggest thing that I've been getting too is, when I sit down with clients and actually explain how easy it actually is. Most people think, I got to come with 25%. I got to do this. I got to do that. It's going to take up all my time. And then when I actually sit down with them and explain what it is to be a landlord and like what the process is to buy a house, they're like, holy shit, are you kidding me?
I want to talk to you more about this because I think anybody who's watching is going to. You're an expert at this, better than I am. In fact, because when it comes to, I'm good with the first-time home buyers or somebody who's just trying to occupy it, but you know a way to actually help folks get into this. Not necessarily any or very little of their own money and get into investment property rentals.
It's huge. So, I'll tell a little story about what I did for a few of my properties back in the day, and then we can kind of bounce off that.
Yeah.
So I bought a 2-unit in Westbrook, Maine back in 2010. Okay. This was after the crash. Everything was super cheap. So it was a really great time to buy. I think, obviously, now we've talked about this in other podcasts. We're not going to see a crash like 2008. No.
It's a different type of lending.
Different times. But anyways, spent $100,000 on this 2-unit back then, which is a 2-unit Westbrook for $100,000 is great. Yeah. Literally put $15,000 to $20,000 into it as far as fix up costs and then refinanced it into a regular loan. But the beauty of it was I used a private lender and they gave me 100% of the purchase price. They gave me the $20,000 that I needed to fix up the place. Yep. And I put literally $10,000 of my own money into it.
No kidding.
So, that was what, 10%? Not even 10% of the equity.
So when you say private lending, you're talking about private capital loans.
Yes.
Yeah, which can be more expensive.
Yep, they can be more expensive. You're going to pay an interest rate of 12, 13%. But the key is you pay that interest rate for 1 or 2 months. And then the goal is to refinance it into a conventional loan.
Right.
Okay. And the beauty is usually you need 25% to go out and buy an investment property.
Right.
By doing it this way, you can literally use almost none of your own money, buy the property, fix it up, and then you have the equity in it. Because when I did the appraisal after that, right? So borrowed 100 to buy it, borrowed another 20 to fix it up.
Right.
When I did the appraisal on it, it was worth 200 grand.
Yeah, see, I flip
now I get
properties
the
this way.
equity.
So I've done the same thing. So I never even thought of it all the years I've been doing it. I flip property, and when I do that, I'm like, I can get this money from private capital. Yep. And everyone will say, why would you do that? It's so expensive. So what?
Makes the deal work.
100% of nothing is nothing if I don't have the cash to do it. So if I can go with private capital, and they'll eat away at a big amount of my profits.
Yeah.
But at the end of the day, I still have profits. Yeah. So it does make sense when it comes to property flipping. But investments, when you're purchasing it as your primary residence, you do get into some legality issues.
You can't really do it as your primary residence. It's got to be an investment property.
That's right.
But that's the beauty of it is FHA will allow you to do it as your primary residence, and you only have to put 3.5% down.
So you could create an LLC, purchase it that way with the intentions to having it as a business or a flip, and then buy it from yourself after that. When you're ready to refinance
I believe you
it?
actually could do it that way.
That'll be another show.
Yeah, that'll be definitely another show because you got to look at the legalities of it. And it comes down to the intent. So when you go to purchase that property, it's the intent that you use to take on the private lending
That's a great point.
capital. So like, for instance, one of my properties I had bought and I bought it with private capital and I said, all right, I'm going to flip this and just make a quick buck. We got into the process and started doing the remodeling and stuff, and we just decided let's move in and we'll make.
Kind of liked it when it got all done. Yeah,
it came out really good, and we're like, you know what, this is actually a pretty good deal, and let's move into it. So it didn't affect any of the legalities of it because our intent when we first bought it was to do it as an investment and flip. But if you change your mind after the fact,
you get a legit change in circumstance, but you have to be careful you're not using it as an excuse. And very quickly, those investors, they don't want to do things that are not right either, so they'll shut you off.
They're going to either shut you off or they're going to ask you up front, like, what is your intention with this property?
Exactly.
And it's a lot of it's to protect them too, because if they're lending to a consumer that's going to buy it as a primary residence, there's different laws as far as when you can take that property back.
Right.
So I stop making payments. It's going to almost take them 12 months to a year and a half to take that property back if it's your primary residence. If it's an investment property, it takes like a month and they get the property back. So they don't want to do that. That's not their business model.
It's not in anybody's best interest. Nobody wants to. But you're right. That is it's all about intent. It's the same thing with the residential world when we're doing it. And here's a lot of confusion too. When I have someone that is purchasing an investment property, but the terminology he uses with me is commercial.
Yep.
It's not commercial when you're going to use something that's 1 to 4 units as residential.
Yes.
So if you have 1 to 4 units and it's if it has a store on it, it's going to be maybe mixed use, but that falls more under commercial. But we get a lot of confusion on that too.
Yep. So really anything that's under 4 units is going to be considered residential unless, like you said, they got the mixed use.
Sure.
Especially in Portland, you'll see a lot of buildings that have 3 units on above and they've got some storefront property on the bottom. That would go under the commercial route. But anything else, 4 units, all residential, that's going to be a regular residential mortgage. And then once you get past that 4 unit mark, you're looking at a regular commercial loan.
Yep.
And a lot of those are very similar to a regular residential loan. The terms are usually less. Usually you can't get a 30-year mortgage, but you can do a 20-year mortgage.
Sure.
And that's really when you do a commercial loan, that's really when the bank's looking at how is this loan or how is this house going to perform. All right. So they're not looking at the personal side of things as much. They're looking at it as a business.
Exactly. Yeah. So in the residential world, it's the same thing. I mean, we're really going to be looking at what is the highest and best use of that property. Is that's kind of the normal for the industry. But
that's also why we look at the rents too, because it is a business, right?
That's exactly
so, why would we expect, the person buying it to just use their income to pay for it? We're going to look at what the rents are.
Yeah, and you also find too that in the commercial world, it's also more about, do you know what you're doing? What is your business plan?
Yep.
It's kind of like if you're going to flip a property, even what we were just talking about, it's often, do you know what the hell you're doing?
Yep.
Because if you're coming to them saying, hey, this is an awesome deal, this property, look how well it's doing, that's great. how do we know you know what you're, how do you
exactly.
know how to use it? You know, that's a big problem because there's a lot of people will come to us or come to me looking to purchase something in particular for commercial. And we have commercial specialists that will talk to them and they don't know what the hell they're doing. They're not ready to get into that route. So that doesn't mean you shouldn't do it, but it does mean you got to get some education on it for that particular type of business.
That's why I love working with these kind of clients, especially first time buyers that are really, you know, they don't necessarily know what they wanted. They don't know how to run a building or the whole process of it,
right.
But they know they want to get into real estate.
Yeah.
Because those are the clients that I can actually, you know, I've been through it all. I've done it all. I've been a landlord. I've flipped properties. I've done all this stuff. And I can be like, all right, this is what you got to do from A to, you know, Z, like 1, 2, 3, boom, you're done. And then, you know, it's such a satisfying thing to like, work with somebody that's not just buying their primary residence. Like they're building like a career for themselves, really.
I love it. My favorite is first-time home buyers to buy multi-units. It's one of my favorite things. You want to talk about how to become wealthy quick? Yeah. That is an amazing step.
There's only a few things that you can do. I mean, even if you're making, you know, over 6 figures a year, there's no way to get really wealthy besides a few things in this country, and one of them is real estate.
It's a big part. You look at anybody in Forbes magazine, and real estate is a big part of their portfolio. But there's no question that purchasing a multi-unit can be a little daunting because when you first start looking at them, one of the downsides of what we're talking about here is, and I can share the mistakes I've made, but one of the downsides is a lot of them need work. If they're for sale, they may not be cash flowing because the landlord has been like, shoot too chicken like me to raise rents, and or whatever the reasons are, they're too afraid to get into the ones that are bigger dollars. So you see a lot of the first-time buyers thinking small. And I can tell you, knowing what I know now, I would think big, go for the maximum I can get with what the average market rent should be. Because the deferred maintenance on them that I've run into has cost me more money than I'm saving some bucks by going, hey, I can get this one for $200,000. I don't want to see the $400,000 and $500,000 ones. They're out of my budget. But are they? Because if the math works and I can go 10, 15 years without having to do anything to it, in the long run, I've done way better that way.
You know, real estate goes up in a percentage, right? So if you know, say Portland, for instance, right? We're expecting to see a 10% increase this year, right?
Right.
Would you rather see a 10% increase on $1 million property that you own or a $200,000 property that you own?
Good point.
You're borrowing the money, right? But it's a loan and you're leveraged up. So like if you're getting 10% on $1 million, you're going up $100,000. That's literally what you made that year.
Yep. I remember certain areas where we used to think, well, that it's going to, like Lewiston, Auburn, I don't want to pick on them because it's actually Auburn's listed as one of the fastest growing places right now. And I'm happy to say I own property there. But for a while, I was like, well, the most that's ever going to be worth is
that's the thing.
$200,000. Not anymore. That's changed.
That was my rule. So for the last 20 years, my rule was don't buy outside of Cumberland County.
Right.
I would not do it. And I always felt safe with Westbrook, Portland, South Portland.
Right.
You're never going to run out of renters, and the equity increase was huge.
Yep.
But now that's changing. Portland has pretty much maxed itself out as far as affordability. So now everybody's going to be moving either south to Biddeford, Saco, or north to Lewiston, Auburn area. And you know, I got to tell you, Lewiston, Auburn, you can still buy a 3 or 4 unit for $300,000, and I'll tell you what, I guarantee within the next 10 years, that's $600,000.
Oh, no question.
But before, it literally, you could buy. I mean, I remember first getting into this business, you could buy a multi-unit for about $150 in Lewiston, Auburn. That wasn't like a dump, you know.
Right.
And you know, over 20 years, it might have increased $50,000. That's it. You know what I mean? But now I think it's going to be a totally different ballgame.
When I first got into business, I remember the FHA county limit, and I think York and Cumberland County was 110 and some change was the maximum. That was when somebody was really maxing out at 110. And I remember that was a big stretch. People were like, oh my God, I got to do 110.
What is it on a 4 unit in Cumberland County right now?
Oh, y'all,
it's got to be like $1 million.
I'll put it up on the screen. I'll put it up on the screen. But and that's another thing that I've seen. I just had this happen. Another lender made a mistake. They said, well, the max loan amount you can do is this.
Was the old limit?
Single family is all they were looking at. They didn't take into account this is multifamily, and on a multifamily, that each FHA, for example, has county limits for what you can have for a loan amount.
This is what we were talking about last. You know, one of the other podcasts is you got to have an experienced loan officer.
Got to have an experienced loan officer because they just didn't know that. They looked up the county limit or whatever they saw, a quick thing on their guidelines, and they weren't paying attention that this was a 3 unit. Now, there's also some things that another lender that didn't pay attention to on FHA, which is if you have a 3 or a 4 unit, there's some residual You need more reserves.
Yes.
But you also need to have what's called a high cost or a self-sustainability test. High cost is not the right wording. A self-sustainability test, which means that if you have a 3 or 4 unit, HUD is going to look at the 75% of all the units, even the one you're going to occupy, and they want to know that that mortgage payment's going to wash out.
Yes.
So what that means is if your mortgage payment's $3,000 and you have $3,500 in rent, in the old days, you go, hooray. Yeah. But not if it's a 3 or 4 unit, because you're going to take 75% of that rental income, and it might be less than that actual mortgage payment you're proposing. It doesn't have anything to do with how much you can afford.
Yep. And that's a good thing, though. You shouldn't be buying properties that don't pass that test.
Right.
Because if 95%, it's just a good way. If 95% of the properties out there pass that test, you don't want to be part of the 5% that just isn't making enough money.
Yeah.
Or you're getting a bad deal.
My point of bringing that up is there are certain areas like Portland, South Portland, even I just had one in Biddeford that those numbers don't track. They just don't work. And they'll go off the appraisal. They're going to go by what the appraiser says, not necessarily for the self-sustainability test. Yep. They're going to go by what the appraiser says and use 75% of that to wash that mortgage payment. But if you do the math in some of those cities, like a 4-unit in Portland might have $12,000 a year in taxes alone. Yeah. And then homeowners insurance, when you add all that in,
12,000. I think that might have been 10 years ago, bud.
You might be right. You might be right. Yeah,
not even close to that.
Good point. Yeah, I'm paying $6 just in Auburn. So the property tax is the entire mortgage payment, and where you get some frustrated buyers is when they look at those numbers and they say, I can afford that all day long. Yep. I know. It has nothing to do with your affordability. You could be a multimillionaire. Yep. You're going to be capped to that loan amount in that area. You do not have to be a first-time home buyer. But the self-sustainability test bites a lot of people.
And the other thing too is though, it say you don't pass that test, and then it's like, but it's really a property that you want to buy. Maybe you look at going in and using private lending, fixing it up even more, and then just doing a conventional.
That's why I like that. I love that idea.
Yeah, there's so many. Like I use private capital on every single flip or construction deal I did back then because it just makes more sense. You're not using any of your own money.
I do it because I don't have any of my own money. So if I could do it with somebody else's money
it's just
all
good
day
business.
long.
Why would it, and even if you had millions of dollars in reserves,
yeah,
it's good business to use a different company's money. It just always is. No matter what the rate is, if you can get the deal to work, it makes way more sense.
It's way quicker,
you take the
too.
liability off yourself.
Yeah.
And that's the other thing that people don't understand too is if you get it stuck in a private lending loan, it's with an LLC that you own. You can walk away.
Right.
You know what I mean? That takes the scare, like especially first-time home buyers. If they know that like they get stuck, they just walk away from it.
Yeah.
It's not the end of the it's not the end of the world.
Not always quite that simple, but to the most part, yeah. I mean, you're right.
Yeah. If you do it smart and you set it up the right way, you literally can have 99% of it being pretty safe. So
I agree. What else do we want to talk about today? We've covered investment properties. We've covered how you can purchase if you're a first-time home buyer, and with as little as 3.5% down, you could purchase your own property if you're going to occupy for a period of time. Yep. I kind of like to touch on another thing you had said with private capital, which I don't always like to encourage in this kind of format because it's a little different, but property flipping, which there's been a lot of property flippers now that I don't really know if I'd classify them as a property flipper. It's the buyers right now that are able to get into a property, and in the long run, I think their intentions are going to be an investment, but they buy it, live there for a year or two while they're fixing it up, and then use that as a stepping stone to the next house.
So that's huge. If you can actually do that, you wipe out all your capital gains.
Right.
So for people that don't understand this, when you buy a property and you sell it at a profit, right? If it's been under 2 years, you have to pay capital gains.
Right.
But if it's your primary residence and you've lived there for 2 years, you don't pay any taxes.
With some limitations.
Yes,
I think it's, and I'll put a little disclaimer on the screen, but I think it's like $250 for a single person of gains on your primary residence, and then $500,000 for a couple. But we're not tax advisors, so we certainly want to make sure we clear that. But you're right, and those are the things that that can make a big difference. And I say this because we talk about investments, but there are a lot of buyers out there to say, I'm never going to get to that investment mindset, but I have, and I'm sure you do too, and a large pipeline of people that are shopping that are not finding the inventory. So what the problem is, they're holding out. And what are we seeing? Prices go up, rates go up. Yep. And will they come down? If they do, you're just going to have more competition. Yeah. But if you jump in it right now, think investment for right now, live there if you can, and fix it up. Yep. Sometimes just the sweat equity over a period of time.
It's huge.
It beats renting. Yeah. I'd rather be in a house that needs a lot of work that I can fix myself over time than to pay the landlord rent.
Yeah.
And I'm a landlord.
Anything is better than renting. I mean, even we talked about this before the show started, is, you know, you don't really see the tax benefits until your first year, and then you actually do your taxes. The write-off of interest, the write-off of deductions, I mean, what do we say? You know, you get a W-2 and you get a refund of, say, $4,000 as a single person.
Yeah.
It's literally double or triple the next year when you buy a house.
It really does. Yeah, you definitely do a lot better. It gives you a lot more options.
Yeah.
You know, some of that's changed with standard deductions on taxes. But again, I think the number one thing that a lot of buyers forget about is, and let's say that property switches. And again, what they forget about is you don't have to get stuck with it either. So many times, well, yeah, but Steve, if this market turns, I'm now going to be stuck with it. I don't think you're ever going to be stuck with not being able to rent something.
Well, that's the thing. And this is why I was saying rents never go down. You know
That's
what I
it.
mean? It's a very rare circumstance, and it's something big that happens with a city where rents go down.
Yeah.
Right. So as long as you can pay the mortgage, just hold out for a little while. You don't need to sell it at any specific time. Do it safe. Have some reserves in case a renter moves out. But you're never going to have, especially in this market.
No.
I mean, it's a waiting list of like 6 months to find anything in like Portland.
Well, I can tell you, this is a little off topic, but my favorite type of investment is single family. A lot of people, we talk about multi-unit, a lot of people really are into that multi-unit type of investment or rental. And a single family is a very different feel, because you'd be shocked what somebody will pay for a whole house for rent.
Crazy.
If they're whatever their reasons are, that they can't do it. You do want to vet them properly. But people that are in a single family property tend to treat it very differently than a multi-unit. Not that there are bad tenants out there, but when you have tenants that are renting, they will not care about the common areas
Well, they
or
don't
outside.
think it was their own. When you're renting a single family house, you almost consider that's your own property. You have that feel, you know, it's your house, it's your
Neighbors
home.
don't even know that they're renting. They see them out mowing the lawn, and they'll do little touch-ups and painting and things like that. So that's exactly it. So I like that, and that's something you can hang on to for a long period of time.
Well, you also can get, you know, I hate to say this because, you know, renters are renters, but you get better renters. It just is it's the case. You know what I mean? Usually when somebody's renting a whole home, there's a reason for it. They're moving for businesses, or, you know, they're building a house or whatever, you know, whatever the circumstance is. They usually have a family. So, you know, anybody that's renting a house usually is somebody that's going to, one, take care of the property better, and two, pay on time.
So I want to talk about another real quick investment before we end the show today, is if you were thinking about making an investment, for example, think about perhaps down in Florida. Yeah. If you were to buy a single family down in Florida, let's say you're about 10, 15 years away from retirement, and you want to start looking
paid off, and then you go to retire, you got a house that's already ready to go.
Exactly. Look at something that's maybe down in Florida or wherever you want to be, and put a tenant in there, and over 15 years, that thing's paid for. When you retire, you have somebody else that basically bought your home. Just make sure your rent at least covers that, plus deferred maintenance.
Yep.
With a property management company down there, you don't have to do a darn thing. Yep. Later on, you have a house. Now, my wife pointed this out. She's like, yeah, what if we don't want to be there in 15 years?
Just keep renting it.
Just keep renting or sell it. At that point, we have a paid-off asset at that point.
I will say this, though. The one thing that I learned, you know, just from doing this for over the years, never sell your investment properties. All right? There's two reasons to this. And I learned the hard way. Back then I was like, all right, you know, we're making a good profit on this. Let's get rid of it.
Yeah.
Like that multi-unit that I did in Westbrook. We sold it 2 years later for an increase of $150,000. All right. So we take that $150,000, but you got to pay taxes on it, right? The reason I say never sell anything is if you want cash, just do a cash out mortgage, right? The benefits of that are you don't pay taxes on a loan.
Right.
This is the way the rich stay rich. All right. You keep taking loans out on your assets. You don't pay taxes on it. Yeah. You sell any of your assets. It works the same way with stocks and everything else. You sell your assets. You pay taxes. You pay capital gains. Sometimes you have to actually pay income taxes, which is even worse. But if you just keep taking loans out, and the beauty is, you do a cash out mortgage. You've usually waited like 5 or 10 years to do this anyways. By that time, the rents have increased enough to pay the new mortgage amount.
Yeah.
You just keep repeating that.
Here's another twist you can do with that too, where you can sell that property and do a 1031 exchange.
Yes.
So 1031 exchange, also I think like-kind exchange is what it's called, is a way to avoid capital gains tax. Again, not tax advisors. There are companies out there that do 1031 exchanges, and we set that up for you. But what a 1031 exchange allows you to do is sell that property. The money goes into the 1031 exchange, so you're actually not taking in a check to yourself, and then you have X amount of days to use it. I think it's 60, but I'm not sure.
I think it's actually longer now, but
maybe.
Like I said,
You've got to turn it.
Accounts, but
so you time that investment where you sell that 3, 4, 5 unit, whatever it is, and you use that money to get a bigger, better one perhaps,
Yep.
or maybe two or something like that, where you just have to use that money or you will pay capital gains on the remaining.
Yep. That's the way to do it. You just never, and obviously there's circumstances where you have to sell properties, but if you can get away with it and not sell properties, I mean, you're saving 25, 30% minimum, of that money that's just going to the IRS.
Exactly. Well, thanks. This has actually been pretty good today.
Yeah, this is a great show.
Yeah. Next time when we come back, you and I are going to do some talking about different programs that are out there too. So we hit a little bit on FHA and some of the other stuff. But I think listeners kind of want to know, all right, I want to buy a home. What are all the things that I need to know about programs?
Yep.
There are so many. And what Integrity Mortgage can do, what we do is shopping out not just what's out there on the secondary market, but what we can do through local lenders. So
Absolutely.
Stay tuned for the next episode. Thanks, guys.
Have a good one.